Okay, I think I'll go ahead and start. So once again, thank you for joining us on Sunday evening. We hope this time is like suitable because we were trying to work out what would be a good time in terms of coordinating, you know, US versus India, and any feedback on that will also be really helpful. So without further ado, let me begin what we have, which is basically we wanted to talk about going beyond ESOPs and ESPPs because a lot of people in the US tend to work for larger tech firms or startups or even outside of the tech space. A lot of compensation happens through the form of RSUs or many companies allow you to participate in an employee stock purchase program, and you also may be getting stock options in the form of compensation. Um, and the primary saving vehicle that we've noticed in the US is the 401k. So, how do we look beyond these elements? And how do we look at making this work for NRIs in the US? Right? So, today I will be the primary speaker. Harshil may not be able to join us due to a personal emergency. And I'll walk you through a few things on how ESPPs can be a great way to create wealth, how you can leverage these kind of compensations that you're getting to make your wealth creation journey smoother, but also looking beyond this in terms of what your investment options are and how you should approach saving as a US based NRI. So one thing is for certain, which is that anybody who's an early believer in a company's success story is the one who benefits the most over a long period of time, right? And when we look at this, what you realize is that anyone, whether they're based out of India or whether they're based out of the US, this is something that they have to go through. And whether you're uh, an employee in a firm, in a listed firm, or whether you are somebody who's participating in a stock um, at an early stage, the benefits of being invested come over a very long period of time. And typically, the benefits actually come towards the end, right? Or after many, many years. So, what you see, say, when you have a compounding horizon of 3 years versus 5 years versus 10 years, the real benefits start coming between year 5 and 10, or even beyond year 10, right? And what you see in the first 3 years is just a trailer of what kind of wealth creation you can do if you're an early believer and you're an early starter in wealth creation, right? So I'd like to walk you through a wealth story. And this is Vijay. He was working in India in one of the big tech companies, and then he got an opportunity to move abroad. And he was working abroad for a while. And he started once he was in the US, he started getting compensated in the form of ESOPs as well as RSUs, right? So he had a salary component, he had ESOPs, he had RSUs, and he had a year-end cash bonus, which could be up to 20% of his annual income. And he could also participate in the ESPP program that his company offered, right? So when it came to Vijay's wealth story, one thing that he realized quite clearly was that employment meant wealth creation. If he had a clear understanding of what his deliverables were, he could have earned that 20% bonus at the end of the year. And his ESPP was structured such that he would make an immediate return of 10% on his investments. So the way the ESPP worked for Vijay was that every month he would contribute a fixed amount to the ESPP. And then at the end of 6 months, he would be allotted shares at a 10% discount to the market. And so on at the end of 6 months, it was very clear that he could always make that 10% return. And if he held on longer, he would make a market return from that day, right? So he thought this was a great investment because one, it allowed him to make assured return every 6 months. Two, it also gave him some buffer in case he decided to hold on to that stock for a little bit longer before he exited. So it gave him some downside protection, right? And his compensation was such that every year a portion of his RSUs would vest. So that created an additional stream of income. So when you look at this, the one thing that you will notice is that while his job was creating a lot of wealth for Vijay, there was this one problem, which was that he was putting all of his eggs in one basket. So his entire wealth creation actually just boiled down to how his company was faring in a particular year, right? Because while he felt confident of generating deliverables and sort of meeting expectations at the firm level or exceeding them, there was always this question mark of how the company was doing. If the company itself wasn't doing well in a given year, there was a good chance that he was not going to get that 20% bonus and it could have been lower than what he was expecting. So this was one thing that bothered Vijay, because after a point he felt that, okay, there are things that are in my control in terms of wealth creation and there are things that are not in my control. The second thing is his salary was also tied to how the company was doing, because along with the bonus, the increments also depend on how the company does, right? The third thing was that he had these investments, whether they were RSUs, whether they were ESOPs, whether they were the ESPPs, all of these investments that he was making, their returns depended entirely on the company's stock price. And again, the stock price was a function of how the company was doing, because it reflected certain fundamental attributes of how his company was performing compared to peers, right? And so when you look at all of this, he knew that there was a big concentration in terms of how his wealth was being created. In the years that his company was doing really well, Vijay made a lot of money. In the years that his company was not doing too well, Vijay tended not to make money. So there was a very lumpy process in terms of how his wealth creation was going. And it was also unpredictable. And after a point, he started feeling that everything was tied to his job, right? And that's not a particularly nice feeling to have, because if he wanted any level of career mobility, if he wanted to do anything else, there was always this question at the back of his mind that, okay, what am I going to do about the RSUs? Because I've got one set of RSUs. So he felt like he was in this cycle where he was sort of stuck, because either something was vesting, or there was a bonus coming up, or there was a raise coming up, and there was always something keeping him stuck in this cycle, right? So just a quick breakdown on what RSUs are. So you only own RSUs when they vest. You don't own them the whole time. So like Vijay was planning his exit, his RSUs vested at a different month, his bonus arrived at a different month, and his raise arrived at a different month, right? And because these three things were spread out, there was always something around the corner that was keeping him tied to the job. Uh, so and the RSU is vested on a yearly basis. So he had to wait a whole year before he was entitled to his previous year's bonus. And like I previously mentioned, this started feeling like his career mobility was reduced, because he had to choose between trading out of his RSUs and switching to another firm. The third thing that Vijay realized is that there were no guaranteed returns as far as RSUs were concerned, because the RSUs were issued at a particular point in time and then they vested at a different point in time, and the stock price could move anyway. It could move up, it could move down between these two periods. And because of that, it was a little bit unpredictable in terms of what kind of return he was going to make. All he knew was how many shares were going to vest, right? And his concentration risk in terms of exposure to his company, as far as his wealth creation was concerned, was that it would sort of increase the concentration risk, because everything kind of depended on how his firm was doing, right? And then when we come to ESOPs, uh, what you need to know is that it's an option to buy a stock, which means you have the right to either exercise it or not exercise it. And you have two levels of taxation. So you have, in India, at least this is how it works. So you have your slab rate of tax, which applies to the difference between your fair market value and your exercise price. Your exercise price is essentially the price at which you can exercise the option, and your fair market value is the price that it is on the particular day, right? And then when you sell this, so what happens is once you exercise the option, you own the stock, right? And then when you sell it, you trigger capital gains, which is basically your selling price minus your cost price or the fair market value on the day that you exercised. So now we have to break down the ESPP component of this story, which is when does it actually make sense to participate in the ESPP, right? So one thing we need to understand is that the 10% gain only works if Vijay sold those stocks every 6 months. If he delayed by a couple of days, the stock price movement could again affect that 10% return. It could be lower or higher. And there was no way of knowing in advance which way it would sort of move. It always makes sense to pay attention to the market cycle as well as the cycle at which the company is in their journey, right? Because you tend to make better returns if you're consistently investing at cyclical lows and exiting at cyclical highs. And the most important thing is that while it's important to accumulate shares, it's also important to decumulate or exit those shares and reduce your concentration risk. And that requires some strategic planning. It cannot be a very random activity, or it shouldn't be entirely liquidity driven as well. So let's make sense of these ESPP cycles. What tends to happen is that when a company is doing well, employees tend to gain confidence in the company's future and they start participating as this confidence builds. But this typically tends to coincide with a cyclical high of how the company is going to go. And that means the stock price is going to move up for some time, but then it's eventually the cycle is going to turn and probably the stock price is going to come down. Now, when this happens, people tend to rethink their participation strategy and tend to taper down their participation, but also they're uncomfortable in exiting or decumulating at this point. So they hold through the cyclical low, and then probably when it comes back to cost or slightly above cost, you start seeing some exits happen. So what is the outcome when this is your strategy? The outcome is always going to be below average, right? Because what tends to happen is that you're buying at higher prices and you're selling at more or less the same prices or slightly higher prices. You are staying invested for a really long period of time, which means that overall you're not really compounding wealth at a great pace. So we need to invert this story a little bit and we need to look at how to restructure it so that we can actually benefit from this great investment opportunity that many firms give you. So the idea is that you need to actually start buying at the cyclical lows. So when the firm is not going to do too well, when you have certain other issues coming in, then you start accumulating at this point and you exit closer to a cyclical high. Then you pause your allocations and you start again investing at the next cyclical low. So when you do this, you tend to buy at lower prices and you tend to sell at higher prices, creating some wealth creation in that process. So one thing that all of us need to know is that stock prices and business fundamentals will eventually converge in the long term. In the short term, you can have some divergence, which is again why paying attention to the ESPP makes a lot of sense, because you should know whether, if you want to make that 10% return, you need to do it on the day that you get those shares, right? Otherwise, you can experience some level of short-term divergence and that need not necessarily work out in your favor. However, if you're confident of how the business is growing and how things are going to work out, you should be able to hold on and focus on the long-term convergence and see through a cycle. So a quick look at how this taxation works in India. It will be different in the US, and it's better to have this conversation with your CPA or with a specific sort of tax consultant in terms of how this works. So in India, if you have an RSU or an ESOP, for long-term gains to apply, you need to held this asset for more than 12 months. And your short-term capital gain tax is at the time of exercise or at the time that your RSUs vest. So when RSUs vest, that gets taxed as income. When ESOPs are exercised, we saw that you pay slab rate at the differential between the exercise price and the fair market value. Then if you sell that within 1 year, right? So once you convert this into a stock, if you sell it within 1 year, you pay 15% capital gains. If it's an Indian-based company, and you pay slab rate if it is a global company, if it's less than 2 years, right? Long-term capital gains for Indian stocks is at 10%, and long-term capital gains for global stocks is at 20% with indexation. So this is broadly how this works, right? So I just want to walk you through one investor that we've been working with in the US. We have many clients who work at companies where they get compensated through ESOPs, and we look at how to sort of de-risk this, right? So when this person came to us, we had his investments were almost 50% in a variety of ESOPs, RSUs, and he was participating in an ESPP program as well. So when we began the review, it happened at a point where the stock had corrected significantly. And this particular investor was a little worried about how this was going to impact his financial goals, whether he'd be able to meet his retirement goals, and a whole bunch of other anxiety that came from seeing this massive change in his wealth, his net worth, basically. So we started the review at that point, and we realized that, even after the correction, about 55% of his wealth was concentrated in this one company. So we realized there was a serious requirement to sort of de-risk and stabilize the portfolio and also diversify fresh investments. So we told him to pause the ESPP for some time because there was already too much exposure to the stock. And while that 10% return was a good investment opportunity, we needed to think beyond 6 months and look at a longer investment horizon, maybe of 3 to 5 years, and to align with his financial goals, which was retirement in about 10 years, right? So that was where the review began. At that point, we felt it didn't make sense to sort of exit this stock. It made sense to wait for some time and then slowly sort of reduce the position size. So about a couple of months later, the stock bounced back, and we felt that this was a good time to do some level of profit booking, and we booked about 5%. We moved from his company stock to other avenues. And then a few months later, we got another exit opportunity. But at this point, we felt that the business fundamentals were turning around and that the business was actually going to do well going forward. So at this point, we decided that we would not take out more and we would wait it out. So that's basically what we've done. And this is something that we can do with people who are working across different industries and companies. We can look at how your ESPP is structured. We can look at the business fundamentals. We can look at the overall position size in your portfolio. We can help you with your asset allocation, and we can help you plan for specific financial goals like retirement, and review how your assets are actually going to get mapped to these specific goals, right? So there is a urgent need for us to look at de-risking for wealth creation because you might have overexposure. That tends to be the norm. There are also some people who don't fully utilize the benefits that are available to them. And that's also something that we can help you sort of review and understand how to structure your savings plan. Right? This is one of our favorite quotes because it basically says that all fortune is good fortune, right? Because this whole story that we've been studying has been about how Vijay has been using fortune to turn his um, investments or his career into wealth. So, fortune is good fortune simply because it either rewards you or it teaches you discipline or it helps you make some changes that are extremely crucial or it punishes you. And because of these four uh, features or these four things that come out of fortune, it is either useful or it is just, right? So whatever punishment we get is because we fail to act in a direction that we should have acted in, and that gives us the structure to work on the next set of things that we need to do, and that becomes a learning in itself. So at this point, Vijay needed to think about how fortune should favor him because it was in his hands to decide what he was going to write in his or how he was going to rewrite his wealth story, right? So he could have chosen to reward himself by utilizing his ESOPs, RSUs, and planning his ESPP investments. He could have inculcated discipline with strategic planning and asset allocation, like how we did for that one investor. He could have also allowed his strategy to continue, and he would have faced the consequences of concentration risk eventually in his wealth creation journey. So, what do we mean by strategic financial planning? You need to have goal based asset mapping, right? Meaning you should know that, okay, your 401ks are directly mapped to your retirement. If you have an IRA also, then that is also mapped to retirement. But there needs to be other investments because a lot of US based investors that we interact with want to retire before their 401ks and their IRAs become accessible fully, right? And when that happens, you need to have liquidity outside of these investment avenues because while they're an excellent way to create wealth, there are some liquidity constraints if you want to retire younger. And that is something you need to pay attention to because that money is eventually yours, but it's not going to come unless you're at a certain age, right? The next thing is goal prioritization, which is essentially knowing what comes first and what comes second and what is most important versus what is least important. So having that sense of prioritization, knowing how to tackle each of your financial goals, knowing how to know, right, where your energies must be focused. All of these are important aspects of strategic financial planning. And lastly, we have to look at asset allocation and rebalancing, which is essentially knowing, okay, not just at a higher level, you're looking at how much do you have in equities, how much do you have in commodities, how much do you have in fixed income, how much do you have in precious metals, and then kind of arriving, or how much do you have in emerging markets, and then arriving at a good mix that works for you and for your financial goals. But also in the specific case where you are getting compensated through ESPPs or through RSUs and ESOPs, you need to also know how much of your wealth or your net worth is concentrated in this one investment and what is a comfortable range for you, right? That allows you to rebalance or redirect your energies and your financial resources to the right avenues at the right time. So the one-stop solution to all of this for anyone who's got a concentrated portfolio on one side is to have a well-structured multi-asset portfolio on the other side, which essentially means that you're looking at a one-stop solution. And this is not just because it's a great investment, it's because it allows you to save every month. It allows you to avoid losses by investing consistently. It allows you to compound in a more regular fashion because you're working across asset classes, which basically steadies the whole, which sort of flattens the whole cyclical effect of investing in just one asset class, right? And it allows you to invest at the right time in the right places because it's always working for one set of investments, right? And now I'll just walk you through how this works for a few people. Many of us, when it comes to deciding how we want to invest, ideally just look at the deciding factor, which is that we like to think that what really makes a difference is the stock that we're picking, right? So it's always like, what is the best investment that I can make today, right? And apart from that, I think the second thing that people pay attention to is when should I start investing, right? So you will look at, oh, the market has been moving up. So maybe this is not a good time for me to start my investments. I'll just wait for the market to correct before I begin, right? Or you will have people who say that I want to wait it out, or you'll have someone who wants to time the market, right? And if we look at how this works in terms of your returns, right? 90% of the return variation comes from asset allocation, which means that if you spend some time getting your asset allocation right, you can get your return story also right through that one act, as opposed to maybe 5% contribution from picking the right stock and 2% from picking the right time to invest. So there's a clear need for us to shift our energies from, say, stock picking and market timing to actually deciding on asset allocation. And when we do that, we'll notice that our journey towards wealth creation is a lot more productive. And this is a well-known research paper that's been published in the US that talks about the deciding factor, right? So multi-asset investing works simply because it suits a wider range of risk profiles, which essentially means that whether you identify as an aggressive investor or a conservative investor, multi-asset investing can work for you. You can be more aggressive and more conservative at the same time, right? Because you exceed the moderate investors' return expectations and you manage the moderate investors' risk expectations very, very well, right? So conservative investors will take a lot of comfort in knowing that their risk is effectively managed. More aggressive investors will take a lot of comfort in knowing that their return expectations are well managed. And we've talked about this before, but essentially it allows you to participate continuously in markets, primarily because at any given point in the market cycle, there's always one asset which is attractively valued, and there's always one asset which is performing, right? So if we want to make asset allocation work for you, we need to be conscious of valuations. We need to stay away from the crowd, and we need to wait and be patient with the way things work out. Because when we're working with a market cycle, our time horizon expands from checking every quarter to checking every year to checking once in 3 to 4 years, because cycles take time to play out. And if we're able to be a little bit more conscious of the price that we pay, then automatically you're saving yourself that little bit extra and creating that little bit extra return from just being conscious of valuations. And then if you manage to stay away from the crowd, which is essentially what we saw in that cycle chart, right? That the crowd tends to move with confidence, and confidence comes with performance. But if we follow performance or if we try to chase performance, then our outcomes tend to be average, right? And lastly, if you want multi-asset investing to work for you, you need to understand that a little bit of everything works together. So I just want to walk you through our product's performance, which is basically NEO, a multi-asset investment portfolio for NRI investors. And these are our performance numbers. I've benchmarked our product against a multi-asset fund in India, as well as flexi-cap funds, which essentially are pure equity portfolio, mutual fund portfolios, right? So when you look at this, we've been doing fairly well on a 1 year as well as a 1.5 year basis. This is a short horizon for you to sort of compare. We would like to have a longer track record, but the ideation from this product has actually come over a decade. We work with investors on asset allocation. We're very conscious of the fact that asset allocation can work for a wider range of people. And there is a need for you to have this kind of diversification that balances out an otherwise concentrated portfolio. So we look forward to showing you more of this data on a longer horizon in the years to come. And we also wanted to look at drawdowns because this is a question that comes, right? Like, okay, so you've shown me the upside and the upside seems great, but what about the downside? And if we look at the downside, I think NEO has done better than the benchmark, which is a multi-asset index. And we've also done better than a pure equity index like the Nifty 50. So you can see that our drawdown has actually been around 4%, whereas the multi-asset index has been around 5%, and the Nifty has been almost double of the multi-asset index at 10%. So one thing is that you have downside protection. So, and this kind of works for the conservative investor, right? Because that's what you're looking at. You don't want to see too much volatility on the downside, and you don't want to miss out on too much of the participation on the upside either. So this is just our performance numbers as of 30th April. So inception was October 2022. So like I said, we're about 1.5 years old as a product. And you will see more of this data. We will be happy to actually showcase this. One of the reasons we chose to benchmark against a pure equity index was because almost 80% of our portfolio today is in equities. And with that sort of larger exposure to equities, we would think that it's fair to look at benchmarking against a pure equity portfolio as well as a multi-asset portfolio. So these are the terms of investments. NEO is a SEBI registered PMS, which means that the minimum investment by SEBI regulations is 50 lakhs. Our benchmark is a multi-asset index that invests across, that has about 50% exposure to equity, about 40% exposure to arbitrage, and about 10% exposure to rates and InvITs, which are basically your real estate as well as infrastructure investments. We don't have an exit load, which essentially works a lot for US-based investors, because ideally at any point that you need this liquidity, there is no exit fee that you have to pay. Our fee structure is flat, which means you just pay 1.5% per year. And this is charged on a quarterly basis. And there are other expenses like GST, etc., which would not be part of the 1.5%, but and any other expenses will be at actual cost. In terms of suitability, this works for a wider range of risk profiles. It also works for basically anyone with a investment horizon of 5 to 7 years. Ideally, we would like to position NEO as a complement to your 401k, because it gives you the same kind of asset allocation flexibility that you have there. And at the same time, you don't have this exit load or a fixed investment horizon. So it works for retirement in a great way. Like I said, our asset allocation allows us to invest across equity, fixed income, gold, cash, and global investments. And we can do this through stocks as well as ETFs. And in terms of position sizing and concentration, our single stock exposure does not exceed 25%, but we generally don't have such a high concentration on any idea. I'd also like you to walk through our entire PMS team. We have four other products. So we have Solitaire, we have TrueBlue, we have Riddhi, and we have Sphere. These are all different portfolios, and you can invest as an NRI into any one of these if you would be interested. Solitaire is our flagship multi-cap portfolio. TrueBlue is a blue chip, pure large cap portfolio. Riddhi is our small and mid cap PMS, and Sphere is a multi-asset, but that basically works for resident investors, and NEO works for non-resident investors. So we have on the fund manager, so we have Shamsa, who's our CIO and our fund manager. And then we have Mr. Balaji sir, who heads research and who's in fund management. We have Rohit and Rajat, who are in Riddhi. And we have Niranjan sir, who heads investment strategy for Sphere. And then we have a research and strategy team, as well as people on investment management and product management on the PMS side. So with that, I'll open up for questions. So if we have any questions, I'll be happy to take them. You can just Type them out in the chat box and I'll get to it. Sorry, it's just taking a minute for my chat to load. Okay, I see. I understand NEO started around October 22 and do not have a longer period of returns, but you have return chart in terms of USD. Also wanted to understand how currency depreciation comes to play for NRI investors, especially US-based customers. Okay, so if I look at historic trends in terms of currency depreciation, it's been in the range of maybe 3%, right? If we look at where we are today in terms of the cycle, the INR has actually been pretty stable. So we've been around 84 rupees for more plus or minus little bit for the last almost 1.5 to 2 years, right? So that is one thing. And that's a trend, I think, which is changing because what you're seeing is that, of course, I don't think I think it's too early to predict any sort of depreciation on the US side. But again, the one thing that most people in the investment world will agree on is that it's very, very difficult to predict currency trends. And so you can keep that buffer. So if you look at ideally, like if we look at, say, a good portfolio return in the US, that would be somewhere around 7 to 8%, right? If you're making that kind of compounded return over a 5-10 year horizon, you're doing really well. Given just how things are structured today and in today's market. If we look at the kind of returns that you should be targeting in India, that is, say, 12 to 15% would be a good range. And if you're making that kind of return, and let's say we subtract 3% as compounded returns, you're somewhere between 9 to 12% on a post currency basis, right? And that's still doing better than what you would get on the US market. So I think that's the way to approach it. And I think with multi-asset investing also, you should be able to comfortably hit that 12 to 15% target. I do not have return chart in terms of USD, but I can try to sort of generate that and maybe share that with you post the webinar. I will take your contact details. If you register, then I think we should have your contact details. If not, could you please drop us a message at this number 95000273. Okay, so how will taxation come into play even there is depreciation? See, tax is unavoidable, right? So in India, if you're having investments here, your short-term capital gains on your equity investments will be that 15%. That is anything that you're holding for less than a year. And anything that you're holding beyond a year will be 10%. Right now, I think if you have, as a US-based investor, there is a double tax DTAA between US and India. So I think if the higher of your tax rate would apply in the US, so you would still have to pay tax on the US component based on whatever your US tax slab is, right? So I am investing in 401ks, ESOPs available with 10% discount, but I stopped investing, started IRA as well. So what will be the path for customers like me? So I think this requires a more detailed discussion and probably like a one-on-one session as well, because you need to understand what your actual targets are, right? And whether you're doing enough to arrive at those targets. And so I would think that you should continue your 401k. If you stopped investing, then we need to look at cyclically where the company is, whether it makes sense to participate or not. We also need to look at your overall concentration in terms of how much exposure do you have to your ESOPs. And then we need to arrive at a suitable allocation for you in terms of asset allocation. And once we're able to do that, then we can actually chart out a path and say that, okay, maybe going forward, 50% of your investments can continue in your 401k. You can continue to do like maybe some amount in the ESPP, and then we can do say 20% in emerging markets, etc. So like we can work out an allocation based on your specific portfolio and requirements. Sir, I've left our contact number here, 9500027285. You can just drop us a WhatsApp message and we can fix a one-on-one discussion. So the first meeting that we have with you, there is just to make it clear, there are no charges. We don't actually, it's just a conversation. You don't have to follow through with anything. It's just for us to understand what you're looking for and whether in any way we can help you achieve those goals as a firm, right? And if we're able to work out something, then of course, we can talk about how this. No, not as of now. We don't have a model for uh, investing in US stocks. So in like if we have, so for instance, like on NEO, we have participated in global ETFs, and that happens on a cyclical basis, right? So we do some level of that, but those are primarily like you're investing through India, right? So in that sense, like we do have some understanding of how global funds and work and how markets are valued across the globe. But if you would like that, then I mean, specifically, we don't have a plan just for US stocks. Okay, so follow-up question. My understanding is you help to manage 401ks, ESOPs, and IRAs based upon your position, and you will help us to invest if we invest 50 lakh in the PMS, like you said, Sphere Neo. No. So one is like we can do a financial plan. Sorry, I think I was not clear on this one point. So we can work with you on a financial plan, which will be fee-based, right? And that financial plan will be structured in a way that incorporates your 401k, your ESOPs, your IRA, how to de-risk, and that's like a continuous engagement. So once we do the plan, that is something that we work towards. And then if there is a need to de-risk or if there is a need to accumulate, that's a continuous journey that happens. Now, in addition to that, if you want to do a PMS or you don't want to do a PMS or you want to manage your investments on your own, that flexibility is there for an investor. So the helping with the 401k and the ESOP and the structuring and deciding how much you should save for retirement and if you want to at the goal prioritization, all of that is part of financial planning. You can choose to do that. If on the other hand, you're just like, no, I want some exposure to India, I don't really need this high level planning and this detailed planning, then you can choose to just do any one of the PMSs and we can work with you on that element. If you want to do both together also, we do both together, which is something that seems to work for a lot of people. But you do have that flexibility to choose how much you want to engage with us and in what capacity. So fee structure for financial planning by SEBI regulations, it's based on the percentage of AUA and the scope of work. So I don't have a table that I can share with you right now, but what I can do is that I can maybe schedule a one-on-one call, and if we have some rough idea of say what the scope of work is and the assets, then we can go ahead and give you like a proposed fee structure, and then you can decide. Okay, so if you don't have the 50 lakhs to start with, I think we'll have to figure out something. In the sense, like, I think for US based investors, mutual funds, there are some restrictions because you have FATCA compliance norms, which means we can work on with 15 to 30 lakhs in the mutual fund side, and there'll be specific funds that we can look at. That should not be a problem, sir. We can do the financial plan and then we can do this, or we can definitely work out something on that side. So I think if you've registered, then we'll have your number. Otherwise, if you've not registered for the webinar and you've directly joined, then I would just request you to please drop us a message on this number. I'll type it into the chat as well so that we are able to contact you. Uh, yeah, there is a requirement to have only one PINs or DMAT account. Um, So we will have to figure out. So operationally, if you already have the DMAT account that we require you to do, then that should not be a problem. If not, we can see what the workaround is and see how to uh, figure that out. So I think for us, the DMAT provider for Neo is HDFC. Thank you, sir. I think uh, we will get in touch with you and we can figure out how to do this next step. Yeah, I think, I mean, there are different providers. It depends on what you require. But if you're looking at working with us, then that would be preferred because that way uh, it's pretty smooth. And if you're looking at onboarding on any one of the PMSs, then we can actually assist you with the forms and all of that. It should not be. We still have a couple of minutes on our meeting. So before I close, I'd just like to thank everyone. I know it's the end of your weekend and you've spent a significant portion of your weekend with us. So thank you once again. And if you do need anything from our side, we will get in touch. I think a couple of people have already been clear about what they're looking for. So we'll get back in touch with you and we'll take this forward. And if you have any other questions, you can always look us up or drop us a message. We're quite active on social media and we'd love to work with you in the future. Thank you. So if you can just tell us specifically what you are looking for, we can sort of schedule the call around that. Like if we know that you're looking for a financial planning solution, if we know that you're looking for the PMS, or if there's anything specific that you want to discuss, that will be helpful in terms of the call. I think anywhere between 15 to 30 minutes can be the initial call to understand what you're looking for. And if required for more engagement, then we can have a longer call as well. But ideally, I think in 15 to 30 minutes, we should be able to figure out what to do and what the action items are. Sure, sir. We'll take that as feedback and we will make the next one for that's more compatible with Eastern time. I think this one we looked only at PDT. So we will do something specifically for the East Coast at a time that's easier for you. Thank you, everyone. Thank you.